All right, welcome to Trading Nation. I'm Brian Sullivan. Thank you for joining us. We're joined by Max Wolff of 55 Capital and Faber of Cambria Investment Management. You recently made an interesting report to those who say the stock market, or retort rather, to those who say the stock market is in a bubble. So if I came up to you at a cocktail party and said, hey, stocks are in a bubble, you would say what to me?
So they're not. Bubbles we reserve for really rare times. In bubbles by definition only happen a very small percentage of the time. So think late 90s. In certain countries, like in India and China, they occurred in the mid 2000s. And one of the ways to think about it is have an objective measure. So we use long-term PE ratios, and we see a bubble is really when no rational person would say there's going to be positive expected returns going forward. So we're looking at U.S. stocks. Long-term PE ratio around 26, future 10-year returns around 4% a year. So not terrible, still positive. A lot of other countries are much cheaper, but the U.S., remember, hit a 45 valuation in the late 90s. And then again, the biggest bubble ever, Japan, hit a value of almost 100. So many countries can get in bubble territory. We don't see any in the world right now.
Yeah, biggest bubble ever. That defined the bubble. Your point is well taken, Max Wolff. If I did the same thing to you, said the stock market is a bubble, how would you respond? Besides, put down that drink.
Yeah, so I'd agree it's a bit of a tough diagnosis. It's a little bit like rabies, right? So you have to diagnoose it autopsy ex post, and that's an unpleasant, sorry, here.
You literally picked the worst possible thing you could get with the 21-foot-long shots in the stomach, but I get your point.
Yeah, so the point is, it is a bit tricky. That being said, what we do think is fundamentally we're entering a different era, because stylistically we have sort of odd and unusual correlations developing all over the place, because we know there's been this huge behind-the-scenes driver, and that's been unusual and sustained extreme monetary largesse from global central banks, pushing rates to really 140-year lows in many cases. We have $10 trillion worth of assets with a negative yield return on them. So we know we're in an unusual situation, and as that begins to unwind, and we would agree we don't know if that started 3 weeks ago, there's some evidence it might have, or if it starts 6 weeks from now. But for us, it's really about gearing all the portfolio decision-making and all the different asset classes that we move in and out of kind of constantly and dynamically to be ready for what we think is a major sea change, because the topography of all of our decisions is about to shift because it was redone. It sort of heaved in 2008 and it was reset by central bank policy. We see that as making it difficult. So it's hard to jump in the same river twice in any circumstance. And if the river had just changed its direction from northbound to southbound, which we think is coming, then we're going to be even more careful about trying to cross thinking we know where the rocks were from last time.
I feel like I've gotten a life lesson as well as a stock market lesson as well about crossing rivers. Max Wolff, we appreciate it. Meb, thank you very much for joining us to talk about a potential bubble lesson. Well learned. We'll look at the Nikkei circa 1990 or whatever it was. Guys, thank you very much, and thank you all for watching Trading Nation. I'm Brian Sullivan. We'll see you next time.
Hey CNBC fans, thanks for checking out our YouTube channel. Here you're going to find videos packed with all of the information that you need to be smarter about your finances. You can subscribe by clicking right here and click on all the videos around me or the I right here to watch the latest from CNBC. Thanks for watching.